Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
It's that time again, a new episode of Zen and the Art of Real Estate Investing, and I'm so excited about this one because we're going to talk unbiased and apolitical economic forecasting for now and the future with the leader in economic forecasting, ITR Economics, and Lauren Saidel-Baker. This is a great show. Buckle up, because we're talking 2025, and we're talking about something big that's coming in 5 years. Let's go. This is episode 234 of Zen and the Art of Real Estate Investing with my guest, Lauren Saidel-Baker. Lauren is an economist with ITR Economics, and ITR Economics is the oldest privately held, continuously operating economic research and consulting firm in the U.S. since 1948. Lauren, welcome to the show.
Thank you so much for having me.
Yeah, I'm excited to talk to you. I know you weren't there in 1948, but this company has been going for a long time and certainly can provide extreme data that's backed by facts, really, and historical evidence, right?
Yes, that is our goal, is to give forward-looking economic forecasting. So we do that with this methodology that was, started to be developed. We've been tweaking the secret sauce ever since, but back in 1948. So really what we're doing is we're looking at business cycles. We're looking at those leading indicators. What tells you what's coming next for your sector? So that is the evidence that I have behind all of my forecasts today.
Yeah, but the evidence is really an important part, because we were just joking before we hopped on that there's so much real estate information out there, but the majority of it's not really based on historical evidence and facts. It's kind of built for TikTok, going to get clicks.
There's a lot of emotion. I mean, this is a very emotional sector. People they feel it. And so I think that's what makes headlines stick. If you can really tap into someone's emotion, they're going to click that link. They're not going to click the boring one that has maybe a more factual or nuanced portrayal of the data, but they're looking for the hot, buzzy headlines. So that's what I really like to do, is pride myself on saying, what is the hard data actually telling us versus what do we want to hear?
Yeah. And I know from, again, we were joking, but I wanted to give everyone this story because I saw you on stage at BPCon 24 in Cancun, and you had said something about being a robot. And I was like, oh my gosh, I think we're going to be friends later because this is what I get. But part of doing what you do is removing the emotion from it and boiling it down. That's something that somebody can take without maybe they still get emotional about the result because, as you said, especially now, it's an odd time. But you're trying to just remove the headline factor and focus on facts, historical evidence, and data.
Exactly. And I'm not sure if I made this joke on stage, but I'm very much an economist that they taught to go on stage. I'm not a public speaker that they taught economics to. When I applied for my job that I'm in right now, which is doing a lot of interviews and keynotes and, this kind of public facing persona, I very much applied for a back office position. I just wanted to be doing the analysis, only talking to my Excel spreadsheets, not talking to any other humans. And when the president of the company called me to offer me the job and explained what it was, I literally told him, you have the wrong resume. You picked the wrong phone number off the stack. That's not me. So that's really where I nerd out and I get excited to dig into the analysis. I don't know what they saw all those years ago, but it's been fun to get to tell the story as well. So that's why I'm doing what I do.
Yeah, but it's interesting because, I saw you on stage. You're great on stage. And I know from my background as an introvert, I do better on stage because it is when you're passionate about what you're about to explain and you know the data like the back of your hand, it's much easier to get it out there. And again, remove all of the hyperbole that's available on every news site.
Exactly. My family will tell you I will talk economics to any captive audience I get. So I guess this was perfect for me.
Yeah, I mean, growing up, was economics always your thing? Is it something that you just kind of fell into, or how
You
did you
know,
get started with it?
well, I studied economics in college. I actually double majored. I was at Wellesley College and I double majored in economics and religion, which is a really interesting combination. Yeah, I
Yeah,
see
you
your
don't
eyebrows
usually,
raising.
yeah,
They say that one major kind of disqualifies you for a job in the other field and vice versa, but it balanced me out. It was fun. It was a liberal arts education.
yeah.
I went to work in asset management, thought I would just study kind of the financial track and take that career, and then found ITR. And really, I say I got back to my roots as an economist. This is not where I thought my life would go, but this is what gets me excited. I want to take that macro view. I want to know what's going on in the world. I want to see what's coming next around the corner, not be surprised when new data comes out or
Yeah.
any number of things can happen. So I think I'm living my best life as an economist. I'm so happy to do what I do.
Yeah. And so, how does an election cycle change what you guys do at ITR Economics? Because there's so much that's in flux, and then there's so much promised, and then so much that happens. It must be every 4 years a different time. It's just different than the other 3 years leading up to this, I was suppose.
Yeah, the short answer is the election itself doesn't change any of our forecasts. And even the party elected, right, red or blue, whether it's the presidency or Congress, right, House, Senate, any of those
Yeah.
things, that does not change our broad view. Things like GDP, like industrial production, like housing starts. Now, specific policies, those can change our
Yeah.
views. The good, bad, I'm not sure if it's, but the outcome of that is we have some visibility. Even with the Trump administration coming in, everyone had an inkling that tariffs were high on their agenda, but
Yeah.
we still don't have visibility. And, we're sitting here and midway through the first quarter of the year, just not really sure exactly how this will play out. So we have plenty of lead time. We can use that, and nothing turns on a dime in the economy.
Yeah.
Our GDP economy is just so big, the largest in the world. Even one person can't sway that direction, all of that momentum, even if that person happens to be sitting in the Oval Office. So we're going to use the leading indicators for the rest of this year, 2025. The leading indicators are really in the books. We have a very clear picture based on those economic fundamentals of what's coming down the pipe at us. Now, tariffs, that could absolutely increase pricing. We see some risks both to the upside and downside on that front. Mass deportations, that's the other one, especially for the construction sector. I
Yeah.
think that could be a risk factor. But broadly speaking, who's in office, that doesn't change, if we've been underbuilding housing and have low vacancies and low inventory today.
Yeah, that's really interesting, though, because I think that people would think that, oh, your entire forecast is going to change. But no, when you've been doing this again since 1948, it's built on the the historical abstract of everything that's happened. But also, what you said just at the end is so important. Whoever is there is still working on things that have been building for years. So it's not like you can just turn on a dime and everything is going to change. And you as a company couldn't make all of these predictions and then just wait to see it just makes a lot more sense to me, but I don't think it's what people expected.
No, absolutely not. But we have run the analysis for every possible combination. What party controls, the White House, the Senate, right? Are they the same party? Are they different parties? We have not yet found a statistically significant and consistent correlation between any party control doing better for GDP or housing starts. Like I said, the momentum behind these factors, behind these major indicators, there is just so much going into that mix. There's so much lead time, so much holdover from one policy to the next. So I always go back to the Warren Buffett quote. He said, red or blue, I can still make green. And I
Yeah.
love that attitude.
Yeah, well, I mean, bringing up Warren Buffett, it's interesting because now he's in the news a lot for withdrawing a lot from stocks and holding cash. I mean, when you have that much money, putting 300 million in cash or whatever doesn't really seem like a big deal. But it seems like he's driving some other idea of what's happening. Is what he's doing in line with what you guys are predicting at ITR Economics?
Well, the stock market, equity prices, that is not a fundamental economic outcome. So we don't forecast that. We watch the same factors anyone else might be watching. There are clearly different strategies to go about this. But from a broad picture, I do expect general growth this year. 2024 was a little sluggish, a little flat in some sectors, down in others.
Yeah.
2025, leading indicators are in the books for it to be a little bit of a pickup, so better growth. Now, that tends to correlate to stronger equity prices, but Not always, right? I think his other quote was, the stock market can be irrational longer than I can stay solvent. So that's why I'm careful to never go to say that these are one-to-one correlations. A lot of weird stuff can happen when you talk about sentiment and pricing, but the economy itself, the drivers that we see for growth, those are looking up.
Yeah, and I think it also goes to a long-term versus short-term approach, which we talk about a lot with just single investor episodes. The good investors are always thinking long-term. They may sell, but they're always looking on the horizon way longer. And that's what you guys are doing at ITR Economics. It's based on everything that's there, instead of just taking, oh, well, here comes tariffs. Let's redo the last 30 years based on that. I think that should be hopeful for investors looking into 2025, that, listen, it's not changing as much as they may think.
No, absolutely not.
Yeah. So what are the main things to be on the lookout for in 2025 for real estate investors, no matter what they're doing? Residential, of course, is big. Multifamilies is huge, but there's all sorts of commercial sectors that are at play in the whole industry. What are you seeing that are really look like, hey, this is definitely going to be part of 2025, with definitely in quotes, because nothing is ever 100%.
Fair enough.
Yeah.
No, I'll go out there with some forecasts, though. We'll put our name on the line. Really, as you talk about residential versus non-res, that is the big distinction to make. Those two sectors move differently in terms of timing through the business cycle. Housing starts, that tends to lead things like GDP, industrial production, whereas non-res starts, just dollar value of construction, that tends to lag behind. And so we actually have about a 2-year gap between the two. Whereas right now, housing has already moved through a bit of a contraction. We can talk about the drivers behind that, but the big one was affordability for a number of reasons. That disincentivized new home construction. We've moved through that cycle. We're now on the outright growth side of things again. So I do see growth for the next, I'll say, at least 3 years in the number of new residential construction starts. We've been underbuilding for a very long time. There is a relative shortage of housing compared to, say, new household formations. So we need more housing stock. However, that affordability constraint, that has not totally gone away. It's gotten a little bit better with our incomes rising, but I think of affordability as a wet blanket that we're throwing over growth. So growth ahead, but maybe a more moderate pace, a little bit cooler. Again, as I mentioned, things like construction labor availability, there are significant risks to the downside. Now, on the other side of that coin, non-residential construction, that's where we still do see growth. Growth is slowing, but that sector is moving about 2 years behind residential construction. So I think this year we're in for a little bit more cooling in the non-res world. It takes longer for interest rates to impact that type of spending. And so we haven't yet seen the full negative effects of that rapid run up in interest rates. So that's yet to come. That's why I'm a little bit more optimistic for something like residential. Again, more moderate, more gradual pace of growth, but growth nonetheless, versus non-residential construction. Give it a few years before we're really seeing growth come back.
Yeah, and just for the listeners, the residential in an economist point of view is multifamily, anything where there's housing, because that makes sense, because then commercial is just going to be traditional commercial real estate that isn't providing houses, office buildings, storage, things like that.
Thank you. And I think the other thing I should specify before I get in too deep here is when I'm talking about my forecast for these markets, I am not talking about like the dollar value of that new home price, right? I'm really looking at the number of construction starts, units started for residential, or we just scale it to dollars in non-res because one project can be so huge or so tiny, units don't make as much sense. But really what I'm talking here is new construction, and that does correlate quite well with renovation. So that cycle moving very similarly.
Yeah, and it seems like the construction starts data was a little bit corrupted by the news just because Texas and Florida in particular just were overbuilding, where everybody else was just consistently building. Is that something that you saw in part of the data, that a couple areas had to stop production, but that's because they just went haywire with it, where everybody else was just kind of consistent?
Yeah, we'll see some reciprocal pressure. Anywhere that booms then, does tend to right size in future data. The oddball, I would say, at the moment is things like all of these storms, hurricanes, fires. There has been a lot of natural disaster type disruption. That's why I'm looking at annualized data, just take an annual average or total to smooth out some of those month-to-month, quarter-to-quarter fluctuations. Texas and Florida specifically, we have seen huge population inflows to those areas. I know every time I'm in Texas, it's just cranes up all over the place. So to see those growth rates really pop, I think a lot of that was valid. It wasn't overbuilding. It was really in response to this natural demand. But once you bring up the total housing stock, think about any future growth rates, right? It's going to be off of a higher denominator, so the growth rate will pull back.
Yeah, and I've been saying that it's not like that housing is going to go to waste. Anything that's paused, no one's stopping moving to Texas and Florida.
No, everyone wants to be there these days.
Yeah, exactly. I mean, weather is something, because weather's not something that you can really put into an economist forecast, but it's out there. But that's another one of those long-term, short-term, because if you look over the long scale, there's been weather type disasters. Maybe they're increasing now, but it's not something that's going to really change your forecast, right?
If I had if I could wave a magic wand and have one forecast be accurate, it would be for weather. That would just help us with so many other forecasts. But yes, we get the question quite frequently, are people leaving the coastal areas, or these more at risk, right? With increasing kind of disaster frequency and severity, I guess you could call it.
Yeah.
But then you look at somewhere like Asheville, North Carolina got hit this fall, and it just, that should have been, that's not a flood prone area. You're not coastal. I mean, some of these storms that do hit these different areas, where do you go if you're moving away? Where would be safe?
Right.
It's just kind of trading off choices. So I don't think we'll see any long-term population flows, at least yet, from those drivers, but that's something we're watching closely.
Yeah. So for just a, say you're a novice real estate investor, someone who's just a general home buyer, wants to buy something smart, make money, what should they be looking for in 2025 to help guide them? Because everyone's always saying, most people are like, oh, it's not the right time, and wait for rates to come down. And then we always say, well, every time's the right time if you're paying attention. Yeah. But what should they be looking at for your regular home buyer, smaller real estate investor, not REITs or these big hedge funds that can buy whatever they want at any time?
I would say first and foremost, the right property is the right property. You'll know it when you see it. We like to suggest if you're on a mountain or a lake or a river, a coast, like those are areas that will never lose value if there's something naturally, I don't know, I'm a nature lover. I love hiking. So for me, it's the mountains, and I just think that's the right place to be, but everyone will find their own kind of fit. Now, is it the right time once you find that right property? I think right now, where we're sitting in early 2025, this is about as low as rates will get this cycle. Back in December in their meeting, the Federal Reserve said they were looking at that point to do another 50 basis points of cuts. That's kind of outdated at this point, just because inflation has been so sticky. We're starting to see, I fully expect to see a resurgence in inflation by the tail end of this year. So I wouldn't be holding my breath for that last two cuts, or maybe even just one more cut. And especially if you're looking at something like a mortgage rate, those do not trend in lockstep with the federal funds rate. Right. So even while the Fed was still cutting in late 2024, mortgage rates were increasing because that's the market's view on long-term inflation. So we can still see rise. We do see relatively elevated compared to, say, the past decade mortgage rates right now. And I think that's something that investors and just homeowners will have to get used to. Rates aren't going back down to those ultra low levels. And again, this is about as good as it's going to get. So I wouldn't be waiting too long for that magic interest rate to come along, saying that, if there's a good time to take out a mortgage, you need a time machine. You need to go back a couple of years to when they were 3 or 4%. But I'm not holding my breath for that to happen again.
Yeah, and I've talked about with so many investors on the show, I mean, the historical mortgage rate, we're just pretty good still right now. Historically, it's not bad. So for people to understand that and then put that into play and understand that you're pretty much getting appreciation if you can hang on in almost any place in America right now, unless you're just crazily overbuying or buying something with huge capital expenditures that you didn't know. So overall, when you look at investments as a whole and where markets are going, 2025 still as real estate seems to be a safe investment, especially the more you know.
We have found that over time, real estate tends to hold its value better than even equities as a just value store. Yeah. So, the appreciation historically has been there. I don't have a forecast. I don't want to mislead anyone. I'm not forecasting home prices or property prices or anything like that. But just the general trend is that we have a shortage of housing. That supply demand curve, like we all learned in Econ 101, price is where that balances out.
Yeah. I think everyone's always trying to, figure stuff out, like, hey, what's going to happen with the investments? But in real estate, if you just kind of hold steady and buy right, you generally will always be okay. But looking out over the next 5 years, are there some things that we should be looking out for that may play a role in what investments we decide to buy, hold, get rid of, or things on the horizon that we should look at? Because I remember there were a couple that I heard and I was like, oh, that's interesting. And again, and based on data, not just,
Yes.
a TikTok video where somebody says, oh, in 5 years, we're going to be in trouble.
Yeah, I love that you targeted it at 5 years, because that is when I think everything I've just said holds no water. And in 5 years, right around maybe 2029, but 2030 is looking to be it. We at ITR, we are forecasting a depression. And so this will be, I want to be absolutely clear, this is not 2008. This is worse. This is longer lasting, much, much more significant economic event, really, because that's when we hit our demographic pinch point with the baby boomers aging, retiring. We just, as a nation, can't sustain the current level of spending that we do. And we're going to have so many more spending pressures on Social Security, Medicare, Medicaid, all of those things that age cohort are going to draw down. Now, we're not in a balanced position today to begin with. If you just look at our national debt, I mean, everyone knows it's out of control. As we said, higher interest rates today, that's higher interest payments. So our government is not in a good position to carry us through the next decade. And I think individuals have to see that as, well, our government's been living beyond its means. I myself should protect myself, live maybe below my means, but do something to protect that downside. So I want to be clear. I do still think there is enough appreciation in those next 5 years from 2025 to call it 29 or 30, that even at the decline, even with the depression, most kind of property classes probably won't fall too far below today's level, right? So take the appreciation, take the upside. But if you are looking at, getting out of those positions in, say your target was 2032, maybe rethink that timing. I think we could be in for a slide down. Now, the really good news, the best part of all of this depression outlook is that if you look ahead through it, protect yourself on the way down, again, be more conservative, look for those flight to safety assets, hold where it makes sense, but buy everything you possibly can once we hit the bottom. It's probably going to be 2034 or 5. It could even be 6, right? This is a long multi-year slide, but that is going to be the best buying opportunity that any of us will ever see.
Yeah, that's really important. I think I did remember the 5-year cycle, because I remember you saying it and my eyes perked up when I heard it. I was like, okay. And I was thinking myself, okay, what do I need to do now to prepare for the next 5 years? And it's stockpile. So I call myself an asset hunter, which a lot of people don't talk about, because I feel like assets are the key. There's the pricing and appreciation and all those things. But if you're focused on an asset that has multiple growth potentials, whether it be geographical or industrial, whatever it is, you're helping yourself for later and giving yourself more options for out. This sounds like something that you're saying would be a good idea. Any type of investment that has multiple opportunities to either earn income or grow in value is going to be smarter now than something, again, that has a more short-term lens, or that you might not be able to get rid of when the time comes.
Absolutely. I think that's a good way to put it. And just to be clear, we at ITR, we have been forecasting the timing of 2030 for, I don't even know how long. It's been more than a decade. It's longer than I've been at the company, but this is really driven by those large swings. So this is not due to where real estate is today. When I say depression, the most recent severe economic cycle was 2008, which really was real estate driven. This is not just rinse, repeat, and go by that same playbook. There will be different drivers. There will be different kind of culprits, like who we put the blame on for why things slide when they do. So I don't think real estate necessarily has to do what it did back then. Don't just play by the same playbook. Look ahead to relatively higher inflation for the rest of the decade. What are the added on implications to any income generating assets at that point? But again, this is the doozy. This is the one to really batten down the hatches for.
Hey, it's Jonathan. I hope you're enjoying this episode with us two robots, Lauren Saidel-Baker and me. Now, I'm not sure if we've gotten to the 2030 projection yet, and if not, it's coming in hot. So you'll want to stay tuned and get all the way through this episode. And if you want to sign up for the newsletter at ITR Economics, go to itreconomics.com, scroll down as far as you can. In the lower right, you'll see free economic updates. Punch in your info, stay on top of it with the leader in economic projections. Let's get back to Lauren. Yeah, and so a potential depression in 5-ish years, does that mean also that at that time that's going to mean foreclosures are back? Because we've seen like literally no housing foreclosures since the pandemic at all. I mean, it used to be such high volume, or at least I guess consecutive yearly, you would have this as it's just not existing other than in the commercial space where there's all sorts of weird debt issues. Is that something that at those times will provide the real estate opportunities just because of the way economy and everything's going to happen at the same time?
Very likely. And I say that as more so than today. I mean, we've been in the perfect storm right now of stimulus checks, right? A lot of people who are maybe struggling got that extra buffer. We saw credit card debt really decline at that point because they put that additional money to the highest interest rate debt first. That makes a lot of sense. It built some leeway, it built some buffer. And with mortgage rates being so low, most folks had locked in. If you bought your house or refinanced your house at that 3-4% rate, it just was less of a strain. So even with the tight affordability today, that's affecting different groups of individuals differently. If you bought your house, if you refinanced at 3-4%, if you own that appreciating asset, you don't feel that affordability pinch so much as someone who's looking to become a first-time home buyer today, or who's looking at rent and they see their rent going up. So it's very much a tale of two cities in terms of those different groups of consumers. Now, looking ahead, as rates are going up, eventually that will kind of reset the average mortgage rate for all of us. It'll take some time. Many folks do want to hold on to their home. You don't want to sell your 3% mortgage to pick up a 7%. Like that's a huge hit to your monthly payment. But over time, again, in 5 years, if you really need to move, you're probably going to bite the bullet, even at that higher cost of borrowing, and do so. So I do see, unless the government does, and again, I don't think they'll have the wherewithal to do anything like the stimulus checks, more strain on the consumer is very likely in that time frame.
Yeah. I mean, and the fact that the rates have gone from 3 to 7-ish is what's leaving the housing industry just kind of vacant of inventory, because it's not that people don't want to sell. It just, as you said, it doesn't really make that much sense, especially if you're upsizing. Even if you're downsizing, you end up selling, doing great, of course, which is the plus, but then you have to buy back into the same limited inventory market. Exactly. So even your downsized, you're going to be at a break even. If you're upsizing, you're going to have to put way out more, and your payments will probably, triple or quadruple just because your rates doubled.
Very easily, yes. And that's the challenge that consumers are facing. Now, I will say the mitigating factor to all of that is the tight labor market. We talked about the labor availability shortage. And at the end of the day, that means wages are rising. And the critical fact for an economist is not just that our nominal wages are rising, but real wages are increasing. That means on an inflation adjusted basis, our wages are rising. So as much as we like to complain about the price of eggs at the grocery store and say how tough it is and how sick we are of all this inflation and how much higher prices are on the shelves, wage inflation has been outpacing consumer price inflation. That puts our consumer in a better position to be able to afford, even with affordability, right, really stretched, it's actually improving. Still, a level is not a good place to be, but the direction is moving in the right way. So that's where I see some of this balancing taking time. It's the offsetting of the two factors.
Yeah, I mean, do you see people eventually choosing to uplift and go to other areas? I mean, we saw it during COVID, people moving farther out and then staying there because of the commute. But if they have to go back to work, I mean, I've been thinking, I live in New Jersey. It's an expensive state in general. My kids are both adults, but I'm like, I mean, what if we just moved to the Midwest?
Mm-hmm.
Imagine the house that we could get in the Midwest for now. I think people are going to start thinking like that, depending on where they are at in their life and where their job is. But do you think that's something, as we approach that 5-year potential depression, that people may consider? Because that could create a drastic help in terms of your overall costs in housing, as you were saying, budgeting now for that.
Yes, that is huge, that trend. And I think it's already happening in key areas. California is the big one for me. Affordability is so strained in California that we're actually seeing population decline. People are moving out of California on net. Yeah,
and it's funny because that means there's an opportunity for people to buy, but it's like California doesn't have deals. No. It's just the deals in quotes somewhere.
Exactly. I think a lot of those are had been rental situations who are moving out. Again, if you are never going to be able to afford that starter home in California, just buy a home somewhere else if that's your white picket fence dream. I think that's what people are finally seeing.
Yeah, and those migration trends are important because they are showing where people are going and where they're coming from. And that's, I would think, is only going to increase, especially for those areas. But the inflow is always going to be there for Texas and Florida, as we were saying before. It's very tax friendly for people for both. Maybe not for property taxes for Texas, but I just every time, of course, we're talking investing all the time. So everybody's like, oh, it's great. You can invest in the Midwest. You can get a 4-family for this. It does make sense for people to think, well, what if I just, outlaid my housing to that state? Especially if they're virtual. And then again, there's still lots of Midwest states that have much more room to appreciate than areas like I'm in, where it somehow keeps appreciating. I don't know how. It's just a market that really doesn't make any sense to other people.
It's wild. And, the population flows, I think that's really an interesting point. We see, like we said, Texas, Florida, those are the two big winners just year in, year out. But to expand that kind of region, I'd say the southeastern United States, the Sun Belt, and the Mountain West, that's where we see a broader demand. The actual, on my current, I probably showed this chart back at VPCon when I spoke, but the current highest growth rate state is actually Idaho. We saw post-pandemic people just pouring into Idaho. I think they all watched Yellowstone and they were like, I want to buy a ranch. And well, you could kind of afford to in places like that. Not that style ranch, but that mountain dream. Then I go back to the numbers, and the most recent growth rate in Idaho, it's 9.8% population growth. And that means last year there were 10 people in Idaho. This year there are 11 people in Idaho. Yeah. So you have to scale some of these growth rates to just what is the existing population. That's really why Texas and Florida, big population denominators, look so much better. That is a long-term trend. I don't see it slowing down anytime soon, because we get into this kind of virtual cycle where Dallas, for example, people are flowing in, educated workers, companies are still feeling that labor shortage. They're creating those jobs. They're really just building up, and it's kind of accelerating the cycle. Other areas like, again, Idaho, Montana, Colorado, and Utah, where we're big for a while, but most of those trends are more driven by I want my ranch, I want to live, have the ski town nearby or whatever it is. Those trends are the ones that I see as being a little bit more socially fickle, maybe. You do have to have that permanent remote work. The return to office won't really work there like it might in some of these big Texas cities.
Yeah, and you brought up Asheville before. And so I was under contract on an investment property in Black Mountain right outside Asheville. Then the flood happened and I got out of the deal because I was like, the whole point of me going to Asheville was I thought it was weather resistant. And now we're finding out nothing's really weather resistant. You're just hedging your bets. But I've seen South Carolina be a big mover for people going there. And I think the Carolinas in general are, because it's kind of, I don't know, for if people do have to go back to work, it's not like they could commute daily to New York or something, but your proximity, it's like if you go Mountain West, maybe you're from California, and if you go into the middle South or somewhere like that, Sun Belt, you're going to have this here from the Northeast because you're at least proximately close to relatives and things like that.
Right. You're at least in the same time zone for meetings, right?
Yeah, it is helpful because you get on if you get 5 people in different time zones now with everybody all over and nobody knows, what the actual time is. Exactly. I'm surprised though that Idaho is still going up because it was like everyone was saying Boise, 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 and then it went up and then you thought it was going down, but apparently not.
Not yet. Not yet, at least. I know some of those inflows have brought a lot of additional challenge. The infrastructure was not really ready to meet all of this demand, the labor force, et cetera. But I haven't seen a decline on the other side quite yet.
Yeah. So for what you've projected for 2025, what are some real highlights that we haven't talked about that can help people, either invest their money wiser or try to figure out what's the best thing to do with their life? I think the 5-year horizon is really helpful because now it's time to start making plans, figure out how to make sure that your money is solid and make sure that your investments are all solid along the way.
Yeah. So I mentioned within the residential sector, multifamily, I really still see very low vacancies there. Rents are very much supported. Rents are still rising. Again, our consumer has rising wages, so they have the ability to afford those rising rents.
Yeah.
I like that space quite a bit at the moment. And again, especially for that very near term, the next couple of years, I think we'll see more support in that market. More broadly speaking, non-residential, that's where we just have to weather a bit more downside in the near term. 2026 is when growth comes back. Some of the highest growth rate forecasts we have are for sectors that I can't get excited about, like mall construction. It's coming back, but from such a low level, right? It will be growth, but it's about level setting those expectations. Don't think we're going back to our heyday of, please no one leave this podcast and say the economist said mall construction.
Yeah, let's invest in malls. I'd never want to go to a mall again. I like the outdoor malls in California. Those are nicer because you're outside all the time, but I can't imagine. And I spend a lot of time at malls. So did my daughter growing up, but it's like, now I think of it and I drive by, they just all look like ghost towns to me.
Yes, that's what it feels like. So I guess we can get trendy and have I don't know, I love my outlet mall. I see more of those going up locally, but otherwise, a couple of places that we might have not overbuilt, but are sort of on the top of things. Warehouse construction was huge a couple of years ago. I see that growing, but again, not growing at that same breakneck pace as when we were revamping our supply chain. We needed those additional nodes in the supply chain, and we consumers, we want our free 2-day shipping. So all of those distribution centers. We've also seen very recently a huge spike in manufacturing construction. That goes to really the more nationalistic trend. As we talk about tariffs, there is foreign direct investment flowing into the U.S. It's a great place to do business. Foreign businesses certainly see that and want to be here. So manufacturing, I think the real peak of growth is just behind us. We might have a little bit of leveling out, but leveling out at a much higher level of construction spend. The big one for me right now is data centers. That is where we just have as close to an exponential growth rate as I have ever seen.
Yeah.
So anything serving those data centers, and the big one, and this has a lot of knock-on implications for other types of facilities, it's power availability.
I was about to say, the issue with the data centers is, where's the power going to come from? That's what I've been reading. Yeah.
Yes, that is the question. There is not enough grid, especially with a lot of these companies are kind of green-minded and they want to be clean energy, and there is not nearly enough capacity for that. So we are seeing the huge spike in U.S. data center construction. That's really straining overall electricity prices. I have a pretty elevated growth rate forecast for overall electricity costs, and that's going to flow down the chain, right, to other businesses, to consumers. Our residential power. I live in New England, where we have some of the highest power rates in the country. We are not there yet with energy generation.
Yeah, I just read something that for the summer for us, and then anywhere really, that it's going to go up 100, just your electric bill, about 100 a month this summer, starting this summer. Yeah, and that's not a good trend. I do think they'll figure it out from a lot of stuff that I've been researching on that, but that's really important, because two of those main things that you just mentioned, they're really like basically unmanned spaces. So it's an interesting, what is that end of commercial real estate? Because even industrial flex was to store stuff. Now it's to store computer equipment and other things where, again, there's not people in there, but there's people still operating a lot of it from afar.
Exactly.
I wanted to get your take on the multifamily aspect, which you are still think is going to be great for the next 2 years. And I agree, because I've been talking a lot about, affordability is very tough now for people who want to buy houses, younger people who aren't going to see the same ease of buying a house as maybe it was, 10 years ago. Yeah. But so I think multifamily is in a great shape, because I think there's going to be tons of choice renters, because what you can get for rent is so much better than what you can get for the same mortgage payment, especially if you look at places who have too much inventory. Right. Texas, just take, for example, they're going to have to start to discount. So you're going to be able to rent a place that's probably like 1.5x better and bigger than the mortgage payment, if not more. Do you see that as a trend that's really going to help multifamily stay solid? And even those delayed buildings will still come up and still be occupied?
I think so. I don't really see falling off in demand for rental. Now, again, the upper income, I guess not upper income enough to be in the kind of home ownership standpoint, but the very lowest income cohort, that is who gets squeezed by inflation a little bit more. So they have felt more strain this cycle. It's that upper middle income, I'm not sure exactly what to classify, but I think you know who I'm talking about here, that would be looking to rent as an alternative to buy. They have a lot of additional purchasing power today. So very stable finances. We don't see any delinquencies like to the 2006 level. We don't see bad debt like that. We don't see just the kind of upside down status of the consumer. That is not in place today. So I would be quite confident in rental situations that, again, as long as you're finding that right person, there are more of them out there, and they do have that additional ability to be servicing rents and debts.
Yeah, and I mean, it's just a different landscape. I found that people can be making their investments before their primary residence, which maybe isn't the way that my parents used to do it, but it makes
Right.
sense now. If you have a nice rental and you're getting a much better place for the money, and you're making good income, and you
Hmm.
want to deploy it into real estate, it doesn't have to be your primary residence because it depends where you live. In California, you can certainly rent something way better than you would pay a mortgage, as we were saying before, because the prices aren't going down for what you can buy.
Exactly. And I would just say our kind of average home price to income ratio is very different today than it was a decade ago, a couple decades ago. So that analysis in a potential homeowner's mind, it looks a lot different today than it used to.
Yeah, are there any tips that you could give people who are obviously, experienced, non-experienced, that are interested in real estate for the long haul? Again, now we're taking your recommendation. There's a 5-year issue coming, but
Yeah.
that 5-year depression could be the best time, as you said, to buy.
Yes.
And I found from myself in 2008 that I made a mistake in 2008. I got scared. I thought everything was going haywire. I just put all my money in cash, like in 0.01% because I was nervous.
Yeah.
And if I didn't do that, I would have made so much money. So now I'm looking at all the horizons and I'm glad I have these index funds. I'm just going to let them ride because I don't need that money. What advice can you give to people who want to stay in real estate, but also probably should be diversified out there with the entire economy and where we're going?
I would say watch the consumer, because at the end of the day, how consumer health in this country is performing, that is your goalpost for anything residential, single unit, multi-unit. That is what you should be watching. So income adjusted for inflation, that's number one. We have a number of other, you can find them on our website, indicators that we follow. Our proprietary ITR retail sales leading indicators is very consumer based. And when we see that start to tail off, that's when we start to get worried. Now, right now, it's not doing that. It's showing a huge amount of stability, a really, really just broad, stable base for economic growth overall, because about 2/3 of GDP is driven by consumer spending. But really specifically for retail sales and for just housing, that level of consumer health is there right now. When that goes away, as it very likely will in, 27, 8, 9 timeframe, that's when you need to see the warning signs. And it will be, again, things like those inflation adjusted incomes where we see this happening first. But a number of different leading indicators, they will be screaming a year or two before we start to see that actual slide. Now, on the downside, I also don't want anyone catching a falling knife, right? When we do see that slip, like I said before, 2008 was 2 quarters of recession. This is several years of depression. So don't try to time the bottom too low. Wait till those same leading indicators tick back up again. That's going to tell us the bottom is here. It's time to invest. I bought my primary house back in 2011. Best move I ever made. It just, timing wise worked out when I needed to be somewhere new. It worked. But my goodness, that is just, if you can recreate that in a much deeper dive, that is going to be a huge, huge upside to be enjoyed in the future.
Yeah. And so I know you said some of that information is available on itreconomics.com, but how does just your regular person stay on top of that information? Where can they find it and how can they actually make heads or tails of it? Because you said it and I'm still well, I don't know. How am I going to track this metric to know when I should do something?
Absolutely. So there are a couple of ways you can do it. If you want to DIY it, all of this information is publicly available for free from government sources. Census Bureau, Bureau of Labor Statistics. My favorite kind of tool that I use, it's called Fred, which it sounds silly, but if you type Fred St. Louis, it should pop up.
Yeah.
Federal Reserve has this database of all of these economic indicators, and you can just search for, inflation, and it'll show you all of the different metrics you can view. Now, I wouldn't just be looking at the raw value of that. I like to put it into rate of change so you get a more apples to apples comparison. That's the DIY. We do have a kind of how-to guide on our website if you want to see how we calculate rates of change, where we get our information, right? What is BLS data versus Census Bureau versus whatever else. But if you want the kind of TLDR version, we have this all on our website. We actually have blog posts. These are freely available. I'm not trying to sell anything. We have a YouTube channel where you can see just different shows. We have a preview of my show, which is literally, we call it By the Numbers. And my whole goal is to cut through headline noise. It's so much fun to do.
That title's perfect for you, right? That's
all I care about are numbers. But we have Fed Watch that my colleague Brian puts out every Friday, just about what are rates doing? What is the Fed thinking about? We have one called Trends Talk, which is more kind of something different. I call it topic du jour. Just what are we thinking about this week? What's something to be watching? But those are a couple of free resources. Again, the blog posts, we're on Instagram. I don't know why an economics firm's on Instagram, but you can find us there if that's where you want to be. Facebook, LinkedIn, the whole social media. And we get excited about what we do. So we are just shouting it from the rooftops when the trend changes, when the forecast is different. Now, we do obviously try to make money in some ways. So we have additional services. If you want to subscribe to like our Insider or our Trends Report, there are other ways to get deeper analysis, but so much of it is free. I think that's a really good starting point.
Yeah, and I think the consistency of going to sites like yours and then it will help you learn that stuff quicker, because it's just like with podcasts and everything. If you just listen to one and if you just listen to this episode, you may have said something quickly and someone's like, I don't know what that is. But then if you go on the site and you start watching, oh, these videos are making sense, and then you do a deep dive, you really want to control that now over the next 5 years. So you have at least a little bit more control. I've always shied away from things that I'm like, I really don't get it. It's like my son's great at chess. I'm terrible at chess. I think I'm good, but I always lose because I'm not patient. But if I just start watching and learning, then I get better. And I think with what you're saying about what it looks like in 5 years, this is the perfect time frame to really stay up to date on economics. So you have a little bit more control and you don't have to be out there trusting, a shiny object on TikTok or Instagram, because that's really what they're looking for. They're going to prey on people who just don't have the time to understand what's happening with the economy, or they're watching just general news sources, which of course are extreme for any direction, or just, plain garbage.
Absolutely. I couldn't agree more.
Yeah. So before we hop off, for your plan now, because the 5-year thing is so helpful to me. And I remember you saying it. I was like, I need to bookmark this in my head. So I'm so glad I got you on the show. This is going to come out in April. What are you doing for the next, with the horizon, what you've known for years is coming in 5 years? What are you doing to protect yourself and your family in terms of investments and what you do? Because I think that will help people get a little bit more of a personal idea of, hey, like, what should I start doing today other than start looking at ITR Economics and other sites that are giving data that can't be changed by the news media?
Absolutely. Well, I'll just level set. If you can't tell, I'm a millennial. So I expect to be in my peak earning years during the Depression, which if you're a little older, maybe you're saying, hey, I'll just be retired. I'll be playing golf. I don't care.
Yeah,
this is
that's
fine.
Me. I'm not going to play golf. I'll just stay in my house and go to the gym and
just
relax. Yeah.
Yeah. But, for someone who is still expecting to be in the workforce, this is going to be a little bit more of a tough thing. The big thing I personally have done is diversified income sources in my household. My husband works in a very different field from economics. So if one of ours goes down, the other should hopefully be there to compensate. Beyond that, though, I'm not in protecting mode yet. There is still 5 good years of growth, actually really stable growth. It would be, kind of unusual to get another big, what do you call it, like a black swan event out of left field. So I don't want to just sit on a pile of cash with elevated inflation that's going to eat away at that cash stored under the mattress. So I really want to make the most of this next 5 years. And I think business owners, especially, whenever I say depression, they're like, okay, I need to not hire. I need to not, get the new facility or scale up or whatever.
Yeah.
That is absolutely wrong. Don't miss the upside because you're scared of the peak. So make hay while the sun shines for the next little bit here around the end of the decade. Again, check in with us. Once it gets closer, we'll have more pinpoint kind of timing targets to tell about. But that's when you just need to pull back, be more conservative. Don't be over levered. Don't be way overweight equities. Look at flight to safety assets. Those typically do well in economic uncertainty times. This time will be no different. Now, it might be a little bit different in terms of our typical biggest flight to safety asset, the safest, risk-free rate you can get, that's U.S. Treasuries. Well, if U.S. Treasury is the problem, that might not perform so well. So look at this cycle for the unique cycle that it will be, but be safe at the end of the decade, weather that downside, and then it's going to be so hard to do. I know this emotionally. We are going to be like that salmon swimming upstream that says this feels wrong because there is so much pessimism. It's the apocalypse, the end of the world as we know it. It's going to be really hard to go out and buy things at that point. But I'm buckling down to put my emotional self, tamp down the emotion and look at the data, look at the leading indicators turn up. That's when you just buy everything you can get your hands on.
Yeah, I mean, that's just fantastic advice. I'm so glad that I asked you that at the end, because it's really like now you can set a plan, and you could get scared and then start, like not doomsday prepping like with cans, but financially doomsday prepping and make bad decisions, which is exactly what I did in 2008. I'm let me just leave cash there. Well, that's just dumb. but I learned my lesson and I don't want to go through it again. So knowing like, hey, we've got 5 years to earn as much as possible, especially if wages are still going up, make sure you're performing at your best in whatever job that you do, growing your business. So, because good businesses really will generally be recession proof in a lot of ways, depending on what type of consumer sentiment is out there, as you said. But if you do great for the next 5 years, you will have weathered the storm as long as you're taking care of the money the right way.
Right. It's going to be a challenge. It sounds easy, but it's going to be a challenge to execute on.
Yeah. One last question for you that just popped into my head before we finish up. Do international assets make any sense as a hedge in terms of what economists think against like the U.S. Treasury and the entire United States for Americans? Because I've been looking at assets outside, not necessarily bank accounts, but real estate outside as almost like a reverse hedge against U.S. economy and real estate.
Yeah, so I don't think any, especially developed Western nations, are going to be immune, even if the U.S. is what brings the world down.
Good.
We're the biggest player. Other nations are, I talked about demographics, aging demographics is really being a trigger for all of this.
Especially Japan. I mean, Japan is the aging is unbelievable. Yeah,
they sell
no one's having kids
diapers than baby diapers in Japan.
Yeah,
it's just
unbelievable.
Yes.
Yeah.
So now that said, different trends come with that, right? That could cause some deflation. There are different kind of factors driven by those different demographics, but no one's perfectly immune. Now, that said, I mentioned diversification. I think that really is a good place to be if you can hedge your bets in different areas. I don't have a strong opinion on international real estate at this point. Again, as we get a little closer, we might change that metric, but maybe not U.S. government treasuries, but foreign government treasuries would be a good hedge. Think of who's typically flight to safety. It's places like Switzerland, places like Canada. Right. They're very conservative. So that could be a good place to kind of ride out the storm.
Yeah. Awesome. Well, this has been super eye-opening. I'm so glad I got you on the show. Where's the best place for people to get in touch with you? Is it through the ITR Economics site?
Yes, ITReconomics.com. You can connect to our customer care team, our amazing account executives if you have any questions about the programs. We have a whole team who's absolutely fantastic. They would love to hear from you.
Yeah, and take Lauren up on what she said is out there for there. I would encourage everybody. I've already been on the site a lot in preparation for this and after I saw you in Cancun. But yeah, I think like I was saying, it's a great time to get educated yourself on the economy and prep for the future. So thanks so much for spending the time. I really appreciate it.
Thank you. It's been a fun chat.
Yeah. All right. That was Lauren Saidel-Baker of ITR Economics. You can find them at itreconomics.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And it's Mike Madsen of RealSource. RealSource is a place where you can invest with knowledge. They have a time-tested multifamily model based on a 35-plus year track record. This is another good one. We'll see you next episode with Mike.